This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Chapter 29 deals with the budgetary process, and again this is very much revision of F5 or even all the way back to F2. I'm going to say very little about it. You would not be expected to be required to calculate variances, but you might be expected to interpret variances, and you might also be expected to explain how you can use budgets as a mechanism of control, because many plans, many strategies are actually eventually conveyed to people by giving them a budget, which is the quantification of a plan. What are the purposes or the functions fulfilled by a budget? And here we have the typical ones. First of all, forecasting. If you're going to be producing a budget, it implies that you must have sat down and done some forecasts. And you can't produce any sort of plan without that sort of discipline and having actually come out with a forecast. Actually put some numbers to it. Not just say sales are going to be good or bad, but actually put sales are going to be 10,000, sales are going to be 6,000, whatever you think they're going to be. It helps you to plan. You have to plan the right cash flows, the right amount of money. You have to plan to produce the right number of units. You have to plan maybe to recruit people. You have to plan how much you're going to be spending in advertising. You have to plan maybe what machinery you need and so on. All of this ties back to the budget. Coordination. It's important that one department doesn't kind of get out of line with the others, that you don't have production facilities for 10,000 units, but your sales budget is only saying, I think I can produce 7,000 units, and then you can only distribute 3,000 units. It's all over the place. You want a nice, logical, coordinated business, and working through the budgets can help you to identify where there may be difficulties in that. Communication. You communicate to people, this is what we expect from you. This is what this person is going to be doing. It gives authorization. The authorization is the budget figure. You say to the advertising manager, your budget is 500,000. And essentially you're saying, you can spend 500,000. Don't come back to me every time you want to spend another 10,000. You can spend 500,000, but in a way you better make sure it's spent well. So it releases, it allows a form of decentralization to people. Motivation. Most people like to be given a target, and if you get the target, then you can be rewarded. You can be somebody can say well done and so on here. But we get a great sense of internal motivation that we've been given a target, we've achieved, and we feel pleased. And finally, we are going to be using budgets for evaluation. Here was a budget, you had to sell 40,000. Here, you've actually only sold 38,000. How come there's a 2,000 shortfall in the units which you've been trying to sell? So comparing budget to actual is the first step in evaluating performance. However, you need great care on this. The difference between budget and actual is basically a variance. But remember, it's the difference between two figures. The actual might be wrong, we mightn't have performed very well, but of course the budget might be wrong. It might have been a ridiculous figure to start with, or there may have been external events which have come along which this person has got no control over. I remember these functions of a budget by looking at the first letters, the forecasting, planning, F, P, C, C and so on, and I've always remembered it by saying few people can carry a male elephant. It works for me. Let's see where to go from this, and let's just mention, as I've kind of hinted already, great care is needed in budget setting. If it is too easy, you are likely to pull somebody's natural performance down. You know, you're going to take the time available to do the task there. If it's very, very high, so that nobody can actually reach it, it's likely to be very demotivating. A budget which you're given over and over and over again, which you could never, ever, ever meet. And then you have to have all sorts of explanations about why you didn't meet it. Your boss shouts at you and so on. It's very demotivating to have constant failure. What you want is a budget which just gets somebody to reach that little bit further, try that little bit harder. And when you try that little bit harder and you get this difficult to target, then there's a great sense of achievement. And there's great skill in setting these motivating budgets. Not too hard, not too easy, just to stretch people. One of the essentials for budget is standard costs. Even if you don't go ahead and do variance analysis, when you're doing a budget, you must have an idea of how many kilograms of material production is going to take and how much each kilogram is going to cost, how many hours it's going to take to produce a unit. And essentially these are standards. And there are a number of different sorts of standards which you can take. And probably one of the commonest ones is currently attainable standards. Those standards which you can achieve under normal operating conditions. Sometimes people might tighten that up a little bit, okay, give you more aspirational standards. Okay, you managed to use 5 kilograms per unit last year. This year, you're a bit more efficient. I'll let you use only 4.9 kilograms per unit. And then once we have the standards set up, you can do variance analysis. Here's what the production should have cost. Here's what it did cost. Here's the difference, which we can break down into all sorts of variances. You will not have to do calculations of variances, but you may be given variances and asked to interpret possible causes for these variances, because the possible causes of variances can give us some direction as to how we can improve matters in the future. So if the material price variance was adverse, in other words, you'd spent too much per kilogram on buying material, then maybe what we need to do is to find some strategy which will enable us to find another supplier, or maybe we take over a supplier so we can get cheaper material, whatever is going to eradicate perhaps this variance suitably in the future. Don't jump to conclusions about investigating causes. Just because the material price variance is adverse doesn't mean the buyer has done a bad job. World commodity prices could have risen. Just because the material usage variance is adverse, don't immediately conclude that the production manager has been sloppy in use of materials. It could be that the buyer has bought cheap but inferior materials, so that poor people in production have to use lots and lots of material because so much of it is rubbish. For variance analysis, you compare budgets to actual, interpretation, possible explanations, and also possible limitations in this variance analysis is what you need to consider it at P3. Now in your notes, all the variances are set out there, showing what the variances are and potential causes. All I'm going to do in this lecture, because this is really old stuff, F2, F5, is just remind you of material cost variances of various sorts here. And that divides into, first of all, material price variance. That's the quantity of material actually used at the price you actually bought it at, compared with what you should have bought it at if you'd stayed buying at the standard price. So principally this is going to land at the foot of the buyer. You're going to go to the buyer first and say, how come you have an adverse price variance or indeed a favourable price variance? But look at the variety of potential causes. The wrong standard might have been set. It might have been an error in the budget so that nobody, even the best buyer in the world, could have bought at that price. It might have been caused by buyer action, very poor, sloppy buying, or getting a really good deal out of the supplier. Maybe there were price changes. Maybe the world price of the raw materials changed outside of our control. No matter how good your buying skills were. Maybe if we were importing the raw materials, the exchange rate altered, and our actual purchase cost would go up and down depending on how the exchange rate fluctuated. So there are many causes of material price variances, not all by any means the fault of the buyer. A material usage variance. This looks at whether we used more or physically less material and evaluates it at the standard price per unit. Why might that have happened? Well, again, maybe we got the wrong standard per unit. Maybe we meant to put in 5 kilograms per unit, but somebody plugged in 3 kilograms per unit on the spreadsheet or something of that sort. Maybe we devised more efficient ways of using the material, or maybe we had somebody who was very careless at using it and wasted a lot of material. That could have been a cause of material usage variance. It could be material of different quality. Bad quality material implies we're going to be throwing lots away or having to use lots to get the yield that we want. It could be poor machine maintenance. So poor machines, the setting slips slightly, it's not as efficient at producing the goods and so on. Probably going to get through more material. This is a cause of a variance which is maybe the fault of the machine maintenance department, not actually the production department at all. It could be poor staff training. And this could be going all the way back to what you pay your staff. You're not paying your staff enough, which is really maybe the province of the human resources people. You're not paying them enough and they leave. And then you get more people in, but you don't pay to train them and so on. And you've got this big staff turnover, poor training. The chances are that you're going to have adverse material usage variances. Again, far removed from the factory. This is something which is maybe more to do with human resources. Now in your notes we cover material variances. We also look at labour variances, sales variances, variable overhead variances and so on. It's worth you going to your notes and just reading through very quickly just to see the great variety of potential causes, because until you know the cause you can't put anything right. Until you know the cause of a problem in the future, you can't improve performance in the future, and you may be falling short of your plans and failing in a strategy.